Several participants indicated that they would have supported a two-sided description of the committee's future interest rate decisions, reflecting the possibility that upward adjustments could be appropriate.
Hello and welcome to The Week Ahead on Nomura Podcasts. I'm your host, Andrew Tysers from our Global Markets Research team, and today's Friday, 20 February. Well, we're now in the year of the horse, of course, but with the US holiday earlier this week, Chinese markets out all week and no major data, markets have been fairly corralled over recent days. Now, we do need to keep a close eye on the US-Iran situation, of course, noting that oil has moved higher over recent days. Any deterioration in the situation there would be serious. In other highlights, US Fed minutes this week surprised. We had Michael McKee from Bloomberg in that earliest snippet, noting that several FOMC officials saw risk of higher, not lower rates. That drew some attention. So this week we'll check in with Jeremy Schwartz from our New York-based research team. I want to get his take on those minutes, along with his thoughts on labour market and inflation clues coming out next week. Meanwhile, in Europe, the Financial Times has reported that ECB President Christine Lagarde could be making an early departure from that institution. So Andrei Stepanek from our London-based research team will be along to discuss that and more. And then in Asia, there are a number of things to look out for next week, including a couple of central bank meetings in Korea and Thailand and some data in India, Japan and Australia too. So Sonal Varma, Nomura's chief economist for India and AEJ, will join us to help unpack some of that. So all up, 3 top jockeys lined up for you this week. Let's get cracking. Let's kick things off in the US. We have Jeremy Schwartz from our New York-based research team, senior economist here with us. Hey, Jeremy, welcome.
Hey, Andrew, great to be back.
Thanks so much. Hey, it looks like a relatively quiet week ahead next week, but we do have some PPI, producer price data out, and I guess that will give us a few clues about inflation.
Yeah, so this is still lagged inflation data, which was delayed due to the government shutdown last year. So this will be the PPI report referring to January. And we are expecting a strong reading for this. Particularly, we think a number of the components which are used as inputs into core PCE inflation were likely quite strong. So one of the most important ones there is healthcare services. And there, every January, you get this update to Medicare prices paid for physicians. We think based on press releases and as well based on some of the October data we've already seen, we expect those increases to be quite strong, which has a large weight in PCE. We also think you're likely to get a decent increase in the price index for portfolio management and investment advice prices. That tends to follow market developments with some lag. And again, that's an area where you can see some of the strong financial conditions we've seen recently actually pass through into consumer prices. So overall, we are already forecasting back-to-back prints of around 40 basis points in December and January. We'll get the December number out tomorrow. We're recording this Thursday. But we think that PPI components should keep that rate elevated going to the start of 2026.
Okay, got it. And look, switching from inflation to the labour market, obviously key data for central banks. There's not too much. We have the regular weekly ADP and jobless claims data coming out too. And I guess we're coming off the back of a payrolls report. So look, I just wanted to ask you, what do you think? What are the survey data suggesting about the health of the labour market here?
Yeah, so broadly, I'd say the recent labor data has been consistent with our view that the labor market remains resilient. We think the slowdown scare in the employment numbers last year was just that, a temporary blip. And we think that while the January NFP report probably overshot on the high side, there's been a range of indicators suggesting that the labor market remains quite stable and resilient. So you've seen the ADP weekly employment numbers start to pick up a bit of momentum. Initial jobless claims have unwound their increase from January, which we think was largely due to the weather. And we sort of expect more of the same from some of the higher frequency indicators next week. I'll say one of the more interesting things on the calendar for the labor data is actually going to be in the consumer confidence report, where the questions on the availability of jobs, or the so-called labor differential, has been underperforming a number of other indicators. That's one sign that there might be some lingering weakness in labor demand, which is going to prevent a kind of more sustainable move lower in the unemployment rate. So we've seen a mix with some of the private sector job openings numbers starting to stabilize and pick up, but JOLTS and the labor differential have remained quite soft. Seeing how that resolves itself is going to be important for how unemployment evolves over the next few quarters.
Okay, got it. I like that word you used back there, resilient labour market. And I guess if we throw in, you're looking for a couple of 0.4s on the next core PCE deflator numbers. You know, for me, that really brings the Fed into view. We did have those Fed minutes earlier this week with a couple talking, or I guess flagging, potential upside risk around Fed funds rate, which I thought was pretty interesting. But we've got some more Fed speakers coming at us next week. They do seem a bit divided. What could we learn next week from the Fed?
Yeah, I mean, so just briefly on the minutes, I think there are two important developments we've been seeing in Fed speak recently, both on the hawkish side. So the first would be this move away from the easing bias. Recall back in December, you had most officials saying they expected rates to move lower if inflation declined. Now it's just several, and even as you mentioned, several now thinking that there's two-way risk to the policy path from here, and that they ought to remove the easing bias from the forward guidance altogether. The other interesting point we've been seeing is a little bit of a pushback on this idea advocated for by doves on the committee, including Governors Myron and Bowman, that strong productivity growth is inherently disinflationary and therefore should lead to more accommodative policy. We've seen a number of centrists and more hawkish officials begin to push back on that. Vice Chair Jefferson last week, and then Governor Barr this week. We also saw in the minutes some pushback with officials saying that while there could be some disinflationary impact to strong productivity, they're equally worried about cyclical acceleration in inflation. So, in terms of major themes, policy is on hold for now. We don't expect too much intrigue about the near-term path, where, again, it seems like even dovish officials are comfortable with remaining on hold for the very near term. So we're focusing more on those longer-term debates about how restrictive policy is and how the Fed should react to the strong growth, which we expect is likely to continue throughout the year. One thing to flag on the calendar that will be interesting is this is the first we're going to be hearing from Governor Waller as he gives a speech at NABE on Monday in the morning, New York time. He did dissent in favor of a rate cut in January, but many viewed that as a political move when he was still in the running for the Fed chair nomination. So he is one candidate to maybe shift back to a bit more of a centrist.
I'm smiling. That's really interesting, Jeremy. Hey, all up, that's great. Let's leave it there. Hope you have a great week ahead.
Thanks, you as well.
The British newspaper saying that the president of the ECB, Christine Lagarde, is expected to leave her position before the end of her 8-year term in October 2027, citing a source familiar with her thinking.
Okay, now turning to Europe, I'm joined here by Andrei Stepaniak from Nomura's London research team. Andrei, thanks for joining. Always great to chat with you.
Hey, Andrew, thanks for having me. I love being here.
Excellent. That's fantastic. Hey, I started there with a little clip from Charles Pellegrin from the France 24 channel. He was noting that the Financial Times is suggesting that Christine Lagarde could be leaving the ECB early. And I saw, Andre, you were quoted by Bloomberg on this too earlier in the week, so I thought I'd come straight to the source. What's going on here?
Look, I think the announcement that Lagarde may quit the ECB early, bearing in mind her term is meant to expire the second half of next year, definitely took some by surprise. That said, we also had Villeroy announce his early retirement only a few weeks ago. This really comes down to the fact that essentially there's the risk of the far right or national rally winning the presidential elections next year. And Villeroy and Lagarde as well now are looking to have Macron be involved in choosing their successors rather than Le Pen or Bardella, depending on whoever ends up standing for the national rally. And the question really is, from our perspective, is does this change the ECB's thinking? I don't think so. Ultimately, the ECB is really a consensus building institution. They want to have a sort of measured view in terms of building consensus to sort of formulate monetary policy. And whoever replaces Lagarde isn't going to radically change or shift that. Moreover, let's not forget, inflation is sort of hovering just below 2% at the moment. It was 1.7% in the most recent print. You have growth essentially at trend. We don't think the ECB is going to change policy at all this year or next year. So from that perspective, it doesn't really change things. The question mark really is, given it's a political choice as well, bearing in mind you have Germany hold the EC presidency, and you recently had Wojciech from Croatia be announced as the vice president. Which countries will be vying for presidency now? That's the big question mark.
Hey, that's so interesting. So there could be a little political overlay in there. I believe Lagarde's actually also speaking in Washington next week, so we might hear a little more. Hey, Andre, you did mention the data there, so let's just dive into that a little bit. On the inflation side, we have some inflation data in Germany and revisions to some European data, which might be a little dull. But look, just in terms of the big picture, how's inflation looking in Europe right now?
Yeah, look, so on Friday, the 27th, we do have some country-level inflation data. So you have Germany, Spain, and France. We have the euro area aggregate figures the following week. Look, essentially, we think inflation will basically print sub 2%, so below the ECB's target for the first half of this year. And that's really owing to base effects more than anything else. And we think it will then essentially rise over the course of H2. We're forecasting inflation to average 1.8% this year and 2% next year. And we think there's really the risk that inflation overshoots the ECB's target in 2028, in part because you have the unemployment rate meaningfully below its equilibrium rate, and that's going to add to wage pressures over the course of this and next year, and obviously feed into services inflation and the wider inflation story in 28.
Okay, got it. And Andre, final question. Let's switch from inflation to growth. There are a couple of business surveys for individual countries out next week. Have you got any thoughts on those, or how are things looking in Europe on the growth side?
So look, we have the IFO on the Monday, the 23rd. We have the INSEE survey on the 24th. We're thinking both could show upticks, essentially following the data we've had so far for the month of February. Look, generally speaking, GDP growth for Q4 was 0.3% Q-on-Q. We think the activities data surveys for Q1 this year will show a similar picture again, forecasting 0.3% Q-on-Q for Q1 26 at the euro area aggregate at least. In terms of the growth picture further out this year and into next year, we actually think growth will really accelerate above potential from the middle half of this year, and in particular in 2027. And that again adds to the inflationary story in 28. I mean, the way we're thinking about this really from a sort of big picture perspective is you have a scenario now where we think we're entering a world more like the pre-financial crisis, where G is above G star and U is below U star, versus the pre-pandemic period where you had U above U star and G below G star. And that's why we do think the ECB will have to raise rates in 2028. Look, circling back to this sort of question on Lagarde's replacement, talking to investors, some people certainly are questioning whether or not a more hawkish member might result in the ECB willing to raise rates more quickly. We don't think so. It's just worth caveating that ultimately it comes down to the data, and it comes down to the fact that the ECB, you have so many members at the executive board and governing council level. You essentially have 6 at the executive board member level, plus all the euro area member states, national central bank governors are part of the governing council. You really need to build consensus to get any decision across the line.
Okay, got it. Hey, Andre, you're obviously across all the details here. Thanks so much for sharing your thoughts here with us.
Thanks, Andrew. Great as always. I'll talk soon.
Absolutely. Thank you. Okay, let's move to Asia. I'm delighted to welcome back Nomura's Chief Economist for India and AEJ, Sonal Varma. Sonal, thanks for making the time again.
Hey, Andrew.
Excellent. Look, let's start with the 2 central banks in the region, which are meeting next week. We've got Bank of Thailand and Bank of Korea too. Are we looking for any action there? Could these ones be interesting?
Well, no action, but should still be interesting. So we do expect both central banks to be on hold, but I would say they are a study in contrast. So for Bank of Korea, we think it's going to be a unanimous decision to stay on hold. Growth outlook is improving, and there are deepening financial stability concerns, both with respect to rising housing prices, but also the weaker currency. So we think the BOK will raise its GDP growth forecast, and inflation in Korea is actually very close to the BOK's 2% target, and we think that's going to be the case over the next 2 years as well. For Bank of Thailand, also we think will be on hold because the fourth quarter GDP numbers came in strong. But we think that there would be 1 to 2 dissents for a rate cut. We also think the statement is likely to be dovish, with BOT flagging that it's monitoring deflation risks and also the spillovers from a strong Thai baht. So we think they'll basically keep the door open to a rate cut. Now, our base case going forward for Korea is that the BOK is going to be on extended hold because the AI boom is actually not benefiting rest of the economy as much. So it's sort of a K-shaped recovery. But for Bank of Thailand, we do expect a rate cut in April.
Okay, good one. That's really clear. Thank you. Look, let's swing our attention over to India. I know that Q4 GDP is coming, and I believe a new GDP data series is coming too. What's going on there?
Yeah, so we'll get the new GDP series. So it's going to be a new base year. Plus, there'll be significant methodological improvements as well. For the fourth quarter, which is the October-December quarter, we are expecting GDP growth at 7.7%. This is slightly lower than the previous quarter, which under the old series was at 8.2%. But I mean, it's still very strong. We think it's going to be led by domestic demand. So the GST cuts that were announced last year should be positive for private consumption, and public capex should also be positive for fixed investments. Now, I think a caveat is in order because given the new series, I think, we could see quite a bit of confusion. It will not be comparable to the older series. But I think, our main message is that India's economy is at a macro inflection point. And as we look out, we see a cyclical growth recovery. Core inflation in particular, is very, very benign. And we think the macro combination is likely to lead to a pickup in capital inflows this year. So India is one of our top pick for regional growth outperformers this year.
Yeah, sounds like a pretty good backdrop. Growth improving and inflation under control. Nice. And look, finally, Sonal, I'll just give you free rein here. Anything else from across the broad region, across Asia, that you'd like to highlight for the coming week?
Well, for the coming week, we're also watching Singapore's core inflation numbers. We do expect this to pick up from 1.2% in December to 1.6% in January, mainly because of broad-based pickup in price pressures. So output gap there is positive, and we think this could strengthen the case for MAS to tighten its FX policy in April. Beyond the data next week, Andrew, I think in general across the region, activity data have surprised on the upside, not just Singapore, but also in Malaysia, in Taiwan. Memory prices are up quite sharply, which is a positive for Korea. So the region is benefiting from the AI boom, not just via higher exports, but also via increased investment in machinery, equipment, and data center construction. So we are positive more broadly on the growth outlook in Asia.
Okay, that's nice. Sonal, perfect. Let's leave it there. Thanks so much.
Thanks a lot, Andrew.
And finally, I'll finish with 3 quick highlights from elsewhere across the broad Asia region. First up, Japan. We expect Tokyo area inflation to slow to 1.6% year over year in February. That's down from 2% previously, due to government measures to rein in electricity and gas costs and due to slower food price inflation too. We also expect Japanese industrial production to surge in January, rising by 5.6% in the month. That's given clues from strong export growth, but that was driven by strong exports to China ahead of the Chinese New Year, so it might not give a really clear signal on the underlying trend. And finally, in Japan, the government will submit a new nominee to the BOJ board to Parliament next week, and this could be really interesting because it will give us a gauge on the government's stance on monetary policy management. Meanwhile, down in New Zealand, we had the first RBNZ policy meeting under new Governor Dr. Anna Bremen this week, and she's joined the RBNZ from the Riksbank in Sweden. The RBNZ made clear that New Zealand is in the early stages of recovery and that the low cash rate, currently 2.25%, will likely need to rise, but in time, and we forecast a first rate hike there in December. And finally, in Australia, the monthly CPI for January will be out next week, and we have this one rising by a modest 0.1% in the month. That would see annual inflation ease to 3.6% from 3.8% year over year, and that would, of course, be a welcome development. I should flag that this is still a relatively new data series with some uncertain seasonal patterns, so our confidence in this particular forecast is unfortunately not especially high. For Australia, I'd also note another solid jobs report out this week, and we continue to forecast another 25 basis point rate hike there, most likely in May. Okay, so there you have it, our views on major market themes and what to look out for next week. This podcast has been written by Andrew Ticehurst and Nomura's Global Markets Research Team and expertly edited and produced as always by John Dalton. Thank you for listening in. If you did enjoy this podcast or would like to hear more, please like and subscribe to Nomura's podcasts on Apple, Spotify and SoundCloud or wherever you go for your podcasts. And if you have a moment, please leave us a review. And as we always say, it would make our day if you could press a few buttons and share this podcast with a colleague or a friend. For more, log into nomurakonnects.com to keep up to date and to keep on listening. Thanks, goodbye for now, and see you next week.
In a complex and unpredictable world, where a sunset in one market means a sunrise in another, one investment bank always looks beyond the horizon to help our clients release the potential of tomorrow, today. Nomura, connecting markets, east and west.
Disclaimer. This content has been prepared by Nomura solely for information purposes. It is not intended to form the basis of any investment decision and is not an offer or solicitation of an offer to buy or sell or enter into any agreement with respect to any security, product, service, including but not limited to investment advisory services or investments. The opinions expressed in the content do not constitute investment advice nor is legal, regulatory, accounting or tax advice and may change at any time without notice. You should seek independent advice as appropriate for individual circumstances. For further information, disclaimers and disclosures, please visit Nomura Connects at www.nomurakonnects.com.